Good afternoon, ladies and gentlemen. Welcome to the JKH Investor Relations webinar, where we will discuss our performance for the quarter and year ended 31st March 2022. I am Gihan Kure, Deputy Chairman and Group Finance Director. I am joined by our Chairman CEO, Mr. Krishan Balendra, who is with us today as well. The format of today's webinar will be where Krishan will initially talk us through the current macro environment and how the group has been coping with the existing macro conditions. Thereafter, we will go through a presentation wherein we will go through the financial performance for the quarter and year ended 31st March 2022, and we will open out the floor for a Q&A thereafter. I would ask you to type in your question and answers, questions to the Q&A tab at the bottom of your screen. So with that, I would like to welcome Krishan to make your opening remarks and talk to us about the macroeconomic conditions.
Okay. Thank you, Gihan. Welcome to everyone who has joined this webinar, and thank you for joining the webinar. I think the macro situation and the situation on the ground, all of those who have joined from Colombo will be familiar with, but for those who have joined from overseas, I will provide an update. As all of you are aware, we have been going through a financial crisis in the country since early this year. It is not something that took us by surprise. We have been lobbying as a private sector through the chambers of commerce and ourselves directly for the government to engage with the IMF and other multilaterals. From about 2 years back, we have been lobbying to structure a way forward for the economy. With the pandemic and some of the other stressors that the economy was seeing, we could see from 2020 that there would be a lot of stress on the macro fundamentals. The crisis deteriorated, situation on the ground deteriorated towards February and March. The forex shortage resulted in shortages of fuel and gas, and that resulted in long electricity blackouts, which then led to social unrest, demonstrations, and so on. We have seen a new team being appointed to manage the economy in April, a new governor of the central bank, a new treasury secretary. We had a new finance minister, and yesterday we had the new prime minister swearing in as finance minister. The new team has the experience, like central bank governor and the treasury secretary. They are professionals. We believe they are taking the right steps. Engagement and discussions have commenced at a technical level with the IMF. Yesterday there was an announcement that the initial discussions have progressed satisfactorily. There was an appointment of a financial advisor for the debt restructuring and a legal advisor, which was announced earlier this week. The IMF have said that they want to see progress on debt sustainability prior to making more commitments to the country. We've also seen the World Bank and ADB step up and divert some funds that were committed to other projects for essential financing for medicines and so on. Also, India has stepped up in a big way, deferred loan repayments, but also provided credit lines for essentials and a number of credit lines for petroleum, which has helped the country to really stay afloat at a time when foreign exchange reserves are at an all-time low. We also had an announcement yesterday that after the Quad meeting between the 4 Quad countries, that India and Japan have agreed to work together to help Sri Lanka to come out of the current crisis. That is a positive development because at a bilateral level we had only seen India formally supporting Sri Lanka, but the signal from Japan, the announcement by Japan, is also a positive signal, because Japan has been a long-term supporter and donor to the country. The social unrest has reduced. We saw an escalation on the 9th of May with the resignation of the Prime Minister. There was some violence on the streets. That has improved. There are some demonstrations continuing, road blockages and so on, but overall the situation on the ground is much better than it was 2 or 3 weeks back. As I said, we have a new Prime Minister and a new cabinet now in place following the resignation of the former Prime Minister, and the team is now working primarily on the economy and on improving availability of essential products, which is the critical need on the ground. For our businesses, we will touch on it as we go through the presentation, but the really big impact has been on tourism. Just as the tourist arrivals were recovering in March, we had recovered to about 50% of pre-pandemic, but now with the bad publicity that we have had around this financial crisis, we have seen numbers falling again. Given that the situation on the ground now is calm in terms of, or better in terms of the social unrest, and that availability is also improving, we are hopeful that the tourism picture will also improve going forward. Looking at the situation today, with the announcement by the IMF and the announcement by Japan and some of the other steps that have been taken, we are confident that over the next few weeks and months, the macroeconomic situation should improve.
Thank you, Krishan. Thank you for that overview. Next, we'll move on to a presentation wherein we'll cover our financials and try to give you some color and perspective on the performance for the year, as well as to give you some understanding of the performance for the quarter and the type of momentum we were witnessing before some of these disruptions. So we will spend roughly around 30 minutes on this presentation, and thereafter move into the Q&A session. So starting off with the quarter, the recurring EBITDA for the quarter, we saw a significant growth from 7 billion rupees to 18.5 billion rupees. And as you can see, if you look at the numbers, if you look at the variance, we've seen all segments contributing towards very strong growth, led by property, where we had the revenue recognition on Cinnamon Life post the handover of the apartments. But as you can see, we've also seen a significant growth in the performance of leisure, transportation, and all the businesses, which have collectively then contributed to this very strong performance that we've seen for the quarter. Moving on to the annual recurring EBITDA numbers, we saw 152% growth, where we saw a recurring EBITDA of 39 billion rupees. Here again, it's a similar story as with the quarter, where we saw all businesses contributing very strongly towards this growth. Again, property for the reasons I just mentioned, but as you can see on the slide, the leisure business in particular recorded a significant turnaround, moving from a negative 3.5 billion EBITDA to a positive 3.7 billion, which is effectively a turnaround of over 7 billion. But we've also seen the transportation business do very well, the retail business and the other businesses as well. And I'll take you through each of the business performances, but I wanted to just cover an overview here. Moving on to the quarterly analysis, and I think this slide is quite insightful in that you can see how the performance of the group has evolved over each of the 4 quarters during the year. If we recall, the first quarter we saw a significant disruption because of the lockdowns due to the pandemic, and even in Q2, somewhere around August, September, we saw significant disruption. So you can see the type of impact it has had on our recurring performance, the EBITDA, where both Q1 and Q2, where the performance was at around 4.7 and 6.4 billion rupees. But as we moved into Q3 and Q4, with the vaccination rates in the country being strong and coming out of the pandemic and life returning back to more normalized levels, you can see how all the businesses have rebounded quite strongly, particularly the consumer and retail business, as well as the leisure business driven by foreign arrivals once the airport opened out, as well as even domestic tourism picking up. So that's what's interesting here. If you look at each of the 4 quarters, you can see how the momentum and business performance has actually got stronger quarter to quarter. We will spend a little bit of time on this particular slide where we reconcile our numbers from what we have reported to how we look at the recurring performance or the core performance of the group. This year in particular, we had quite a few one-off or exceptional items or adjustments, which I will talk you through. So if you look at the table on the left, you can see the reported EBITDA, which was at 29 billion, and the recurring EBITDA number we just spoke of, which is at 39 billion. So the main impacts that we've seen here is that we had a one-off impairment on the goodwill of our investment in SAGT that's arising from the original investment and the carrying value that we had. And given that we have just 7 more years to run on the concession, we have impaired this particular investment, the goodwill on the investment in this particular year, which is at around roughly 5 billion. There were a few other minor adjustments in the transportation business, but it was the SAGT goodwill that comprised of the bulk of this 5.3 billion that you see on the screen. We also had an adjustment or impairment on the Cinnamon Life, the office complex. Now, this of course being a new project, one may wonder why we have taken an impairment. This is on the office tower where we treat that as an investment property. So as we get into operations, this will continue to be treated as an investment property. And given the current market conditions, and given that this particular building is actually accounted for in US dollar terms, and whilst we have dollar rental streams or dollar linked rental streams, these may be somewhat capped. So because of that, we've, as a measure of prudence, decided to take an impairment on this, which is again a one-time hit that we have taken. So both these adjustments collectively amount to roughly around 10 billion rupees, which is why our recurring performance on EBITDA is 39 billion rupees. Moving to the table on the right, you see our reported PBT at 27 billion. And again, we have the same adjustments on the impairments, which I won't talk through, which we just went through. But we also do have net exchange gains that we had in the group amounting to around 12 billion rupees. Now, these exchange gains arise from some of the dollar cash balances that we have held as a group. And these cash balances, of course, are essentially held for the purpose of managing our future investments into Cinnamon Life, as well as to take care of some of our debt financing requirements. So it is held for that purpose, and it provides us that hedge to take care of these future liabilities, which will arise over the next couple of quarters. But as a result of that, we do have an exchange gain because of the sharp movement of the rupee. So if you adjust that down and take that out, which is within the 27 billion of PBT, but then we also have added back the one-off impairments that we spoke of, which then gives rise to a recurring PBT of 24 billion. I think I'll also take this opportunity to just mention that the recurring EBITDA number does not have or does not include the exchange gains that we just spoke of. So you can see how the 29 billion moves to the 39, but even the 29 or the 39 does not include the exchange gains that we spoke of. Moving to the next slide, we'll take a few minutes just to understand how the debt position of the group has moved over the last couple of years. as we've now got to completion of Cinnamon Life, which is a close to $1 billion project. We've naturally infused funds, and now we've started recognizing revenue and profits, which we will talk about, and within the next year we'll get into generating recurring cash flow streams from Cinnamon Life. But of course, as we've completed the project, you can see that our debt levels on a gross basis have increased. This is also affected by the fact that we have US dollar debt on our balance sheet, and with the marked movement of the currency, the depreciation of the rupee equivalent of that debt has increased significantly, and that's where you really see the movement from FY21 to 22. It's not necessarily an increase in debt. There is some level of an increase, but it's actually coming more from the rupee equivalent of the translation of our dollar debts that's coming through. If you look at the second line there, you'll also see the cash and cash equivalents. Again, as I mentioned earlier, we are carrying a significant amount of dollar cash for some of these commitments. But similarly, we've benefited due to the depreciation. So therefore, if you look at the cash and cash equivalents, it's again largely the translation, though we did have some fresh funds coming in through the ADB investment as well. But apart from that, we've actually seen the benefit coming through. So if you look at it on a net debt basis, which is the third line that you see there, we've seen our net debt increasing, but actually though our gross debt is at 230 billion, our net debt is actually at 77 billion. And if you look at it against the recurring EBITDA, which we spoke of earlier at roughly 39 billion, we are looking at a net debt to EBITDA, recurring EBITDA of around 2 times, and a net debt to equity of around 23%. Moving on, to the business updates. So if you look at the transportation business, I'll talk to you about the numbers for the benefit of some of the foreign analysts who are on this call. I won't spend too much time. We spoke of the WCT project, but as we can see on the slide here, we know the strategic location of the Port of Colombo. We also know that the East Container Terminal and the West Container Terminal, both these projects are now, we've commenced construction, or the country has commenced construction, and the West Container Terminal is something we hope to have operational, the first phase of it, in the next 24 to 30 months or so. If you look at the chart on the right, what's interesting here is the way volumes have grown significantly over the years. From 2013 up to around 2018 or 19, we've seen very strong, sustained growth in the Port of Colombo, which is actually capacity-led growth. So with CICT coming on stream, which was the only, or which is currently the only deep water terminal, Colombo was really able to attract new generation vessels, and that really helped drive volume growth in the Port of Colombo. Now, once we've got to 2018, 2019, we can see that volumes have started plateauing. There's of course a pandemic related impact, which is why you see the 2020 numbers coming off a little bit. But the issue is that the Port of Colombo lacks adequate capacity, and growth is now curtailed due to that. So the development of the West Container Terminal and even the East Container Terminal is long overdue and will help ease the congestion that we may start to see at the Port of Colombo till such time we see the new capacity coming on stream. Moving on to the quarterly numbers, I won't spend a lot of time on this slide, but you can see how volumes at SAGT have been fairly consistent. It's been slightly up and down if you look at it quarter to quarter, but at 460,000 TEU, that's roughly the sort of capacity that we can do. We've seen a slight uptick from the previous 2 quarters in the domestic mix, which naturally helps overall revenue and profitability. And overall profitability in the business has been helped by ancillary revenue growth, as well as, of course, when we look at it from a JKH group in rupee terms, the benefit of the currency depreciation as well. The bunkering business saw 2% growth in volumes. but the main growth in profitability was driven by an increase in margins, as we've seen base fuel prices increasing significantly, and that has given space for the bunkering business to enjoy better margins, and both these factors have contributed towards an improvement in profitability. Moving on to the consumer foods business. If you look at the consumer foods business, we can see the performance, the volume projections on the left of the chart, where all three segments, the ice creams, soft drinks and convenience food businesses, saw double-digit growth in volumes, and the recurring EBITDA margins were at around 17%, which is lower than last year or the year before. But in the next slide, I'll talk to you about what's actually gone on. When you look at the quarterly breakup of performance, you'll actually see the impact on recurring EBITDA. We've naturally seen some cost pressures coming through as well, and we'll talk about that in the next slide. But overall, this business, if you look at the momentum for the quarter, we've seen still about a 20% growth in the recurring EBITDA performance for Q4. Moving on to the quarterly analysis itself. Again, just to remind you, the impacts that we saw in Q1 and 2, which I spoke of earlier, and the impact it had on the consumer-related businesses, particularly because we had lockdowns in the country, and that naturally affected volumes and activity on distribution. So if you look at it, of course, when you look at this chart, you will see Q1 showing growth, but that was off the base of the previous year, where we had complete lockdowns for pretty much 2 months of the first quarter. So you're looking at growth, but that's off a very low base. But if you look at this year's numbers, you can see Q1, we had a recurring EBITDA margin of just 9%, and as we move to Q2, it improved slightly to 13%. So that combined effect of the first 2 quarters is why we've seen the annual impact being at 17%. But if you move on to looking at Q3 and Q4, you can see the type of volume growth, particularly in Q4, we saw the sustained momentum being maintained, so at 25% and 34% on ice creams and soft drinks in terms of volumes, and even EBITDA margins growing from 18% to 21%. So if you look at the second half, you can see it's very different to the first half. Now, having said this, when we discuss the outlook, we can get into more details on this. We are seeing quite a pressure on our cost structures, given the disruptions we are seeing on the supply chains at this moment of time. We are taking mitigating actions on this. We've looked to increase prices. We are looking to manage our supply chains by reducing the disruption as much as possible through forward buying and so on, to ensure that we keep the manufacturing going, and thus far we've been able to do that. But the cost pressures continue, driven by a couple of factors. One is naturally the significant depreciation of the rupee, but apart from that, we've also seen significant increases in global commodity prices, freight rates and so on, which is also impacting overall input costs. So we will do our best to see how we manage that through productivity, efficiency improvements, but naturally also there's no way of avoiding passing on some of these cost increases to consumers, and we look to protect our margins as much as we can over the next couple of quarters. Moving on to our retail business, again here if you look at the column on the left, you see our performance for the year, where we saw same-store sales growth of around 13%, driven by a combination of footfall growth and ABVs. If you look at the numbers in the previous year, footfall and ABV, as we've said before, because of the pandemic and consumer behavior being disrupted, it's not very representative at the time, but as we go forward and as we get to the next slide, I'll talk you through the quarterly impacts and how we are seeing footfall and ABVs behave. But overall, as you can see, the annual performance here, we've seen the momentum through 2021 continuing, where our recurring EBITDA margins again increased to 7.8%. But again, we'll see how it has behaved actually over the 4 quarters, going back to a similar trend that we saw with consumer foods. In terms of Q4, we've seen the momentum continue. It's driven mainly by our supermarkets business. Our office automation business, whilst at a EBITDA level, we did enjoy growth, and we saw volume growth. Because of the currency move, we had a significant impact on some of the outstanding trade bills, and as a result of that, there were some forex losses that we had, which is reflected at a PBT level. So looking at the quarterly performance of the retail business or the supermarkets, you can see again how the numbers have moved. So if you look at the recurring EBITDA margins in Q1 and 2, when we had these disruptions, it's been at around 7% and then 4%. But again, a strong bounce back in Q3 and 4 as we've moved from around an EBITDA margin of 8.5% to as much as 10%. Now, we've seen strong same-store sales growth in Q4, as you can see here, almost a 19% growth in same-store sales, driven mainly by footfall. We've benefited from ABV growth as well, as inflation has naturally translated to higher revenues. But we are seeing a significant impact of footfall growth, a positive impact, where consumers are now shifting to some extent from general trade to modern trade. And this is driven by the fact that there's been a lot of supply chain disruptions. And whilst modern trade has been able to maybe forward buy, stock up, use the balance sheet for working capital purposes, general trade has been more impacted and unable to do so. And as a result, the stockouts have been greater. So modern trade has been a sort of indirect beneficiary as a result, where we've seen that footfall growth. We've also, in our supermarkets business, done a lot in terms of our own actions, in terms of what's controllable, to look at more direct purchasing, so that we've not only done direct purchasing, but also continued to drive our private label range. So that's achieved two objectives or three objectives. One is that it has helped us to reduce the gaps and ensure that we've have inventory in our stores. We've also given consumers a wider choice by ensuring that we've expanded our private label range, and through that we've ensured that they're given more choice at different price points. And of course, by doing this, both these combined actions, we've tried to preserve our margins or actually get benefit of better margins, which has also helped translate to better profitability. Now, as we look at the outlook for the next year, we still see this trend continuing because of these supply chain disruptions, possibly continuing at least for the next quarter or two. The challenge, of course, will be still ensuring that our suppliers are able to fulfill all the orders and the demand that is there. We do have some disruptions naturally with the power cuts and so on, but we are managing that through the disruptions through running our generators and so on. Fortunately, now the power cuts are not as debilitating, so it's a couple of hours and we are managing that. So the outlook for this business still looks quite strong, though there can be other disruptions. We still see overall revenues and growth in footfall. In terms of our outlet expansion, last year we opened 5 outlets. Some outlets were delayed slightly because of the pandemic-related disruptions. Heading into next year, we will continue our outlet expansion, but we will naturally look at the feasibilities a little closer, looking at the type of impacts we're seeing on the ground, particularly with the cost of constructing a new outlet. There are impacts on our investment. But on the flip side, we see the benefits coming through because we see higher revenue in all our stores, and even a new store would see that benefit. So that's something we think would offset the impact of potentially higher costs of construction of our new stores. Moving on to our leisure business, you can see here, I won't go through the details on the slide, but before April 2022 and post around late last year, we've seen a strong growth momentum in leisure, the arrivals to Sri Lanka. And unfortunately, with the current disruptions that we've had, the social and economic unrest, the shortages, that's affected arrivals, and particularly with some of the travel advisories that have been there, we've seen a negative impact. But what's interesting to see is how the numbers from November, December, each month we saw growth, and we had reached roughly 50% of the pre-pandemic levels of arrivals that we saw to the country, and that would have continued if not for these current disruptions. So we are quite hopeful that the current situation in terms of the supply chain disruptions and the unrest will settle down in the next couple of months, and we should start seeing a strong recovery in tourism thereafter in Sri Lanka. Moving on to the Maldives, here we've seen a strong recovery momentum, and as you can see from the chart here, from around mid last year, we've seen the Maldivian numbers being close to normal levels, and as we got towards November, December, we actually saw arrivals being pretty much at pre-pandemic levels, and our occupancy in our hotels were at pre-pandemic levels. So that was very encouraging to see, and we are seeing that trend continue through even now as we get into the lower season months. We are still seeing the numbers being very strong. On this slide, we just talked to you a little bit about the potential for tourism in Sri Lanka. I think we all know it, but given that we are so close to India, which is one of the largest markets, or will become, we believe, one of the largest markets, a lot of key Indian cities are within a couple of hours flight time from Colombo, so it opens out a huge opportunity. And if you look at this chart, you can see how China has performed over the last 10-20 years off a base from 2000 to what it was just prior to the pandemic, how it grew from 10 million outbound tourists to around 150 million outbound tourists. Now, India has not grown at the same pace. Naturally, they are a little behind in terms of the travel of the middle income group in India, that market. But as the prosperity of the Indian middle class grows and the Indian economy itself sees the type of growth momentum that it's witnessing now and is expected to witness over the next couple of years, you could potentially see Indian arrivals follow a similar trend, or Indian outbound travel, and we just need a fraction of that to actually come to Sri Lanka. Here, I won't spend time on this. You can see the type of recovery we've seen in our city hotels, the Sri Lankan resorts and Maldivian resorts, which has been quite promising post-pandemic, which shows the trend of recovery that we were seeing, which was a sort of global trend that most countries were witnessing. Here you can see the annual impact of our occupancy and ARRs. Naturally, the base that you're looking at for FY 2021 is very low, but off that base, we can see the type of improvements that we've seen. And if you look at the Q4 update, the box on the right, you can see the type of impact that it's had, where the recurring EBITDA from just being barely positive has now moved into a 3.2 billion positive EBITDA. In the Maldives, this trend is naturally expected to continue, though like I said earlier, in Sri Lanka, we hope that things will settle down and we can start seeing the momentum we were seeing in the month of March. Moving on to the next slide, where we show the quarterly picture. Again, you can see the Q4 numbers for the Colombo hotels, where occupancy had recovered to around 50%. In Sri Lankan resorts, we had seen occupancy close to 60% for the quarter, with ARRs at $90 plus, which was getting to quite a healthy territory. And you can see the EBITDA margins that we were witnessing in Q4 in Sri Lankan resorts, which is of course a peak season. With the Maldives, we've seen occupancy being steady at around 90%, and again see ARRs go up to $400 plus, and the recurring EBITDA margins being very strong at almost 50%. Moving on to our property business, here we see the number of units we've sold on our Cinnamon Life project. So on a cumulative basis, we've sold 267 units in the 2 residential towers at Cinnamon Life, with a remaining inventory of 160 units. Now the 267 units, we are in the process of handing over some of the units, but we have recognized the revenue on the entirety of the 267 units. So that's partly the positive impact that you've seen in Q3 and mainly in Q4, in terms of revenue as well as the recurring EBITDA, where you see the 5.3 billion rupees for the quarter, mainly driven by that. So around roughly 75% of that number is actually coming from Cinnamon Life. And we also have the benefit of revenue and profits being recognized at Trizen, where we are recognizing revenue actually on the run, as opposed to Cinnamon Life, where it was the complete revenue that we recognized. These are just some images of Cinnamon Life. So as we get to completion, you can see the previous image was actually an artist's rendering. This image is actually an actual image of the status of the project, and you can really see how iconic and transformational this development can be for not just the John Keells Group, but even Colombo and Sri Lanka as a whole. So this is the office tower which has now been completed, and we have 10 floors that are occupied by an offshore software services company. I'll just spend a minute on this particular slide where all the different components of Cinnamon Life are covered here. I think all of you all are quite familiar with this, but on the right hand side you can see the legend. We've given the breakup of all the different components. The conferencing capacity, we have around 5,000 packs there, so that's a significant opportunity for us to drive MICE tourism into Cinnamon Life. Supported by the 800-room hotel that we have, 15 specialty restaurants that have around a capacity of 1,300 packs, and that's not even taking into account the all-day dining facility that we have. And then the mall, we have around 300,000 square feet, of which 150,000 square feet will be the core mall and around another 160 for entertainment. We've already spoken of the residential piece, so I won't get into that. So if you look at this slide, again, this talks of the growth in Indian MICE travel, which we believe will strongly complement the offering at Cinnamon Life. And the MICE market itself, if you look at outbound MICE travel from India and China, you had around 2 million and 5 million numbers pre-pandemic. And Colombo is well poised to take advantage of the numbers, particularly out of India, given that our sort of ARRs and the conferencing package rates actually could be lower than even India. And the travel time is a lot lesser than many other regional destinations. Now, whilst the airport capacity will increase, we also need the low-cost carriers to come in. And with a few tweaks like that, we believe that the cost of connectivity also can come down, which is one of the barriers. And if that barrier is taken off in terms of ensuring or attracting more LCCs into the country, we believe that products like Cinnamon Life can really take off. If you look at financial services, we've seen strong growth throughout. The business has seen very strong GWP growth as well as the underwriting of new business. Union Assurance did very well for the last year in underwriting of new business, and that momentum has continued. So the annual performance was very strong. The recurring EBITDA performance, sometimes in the insurance business, the recurring EBITDA quarter to quarter is a little distorted because, as you can see, a lot of the revenue actually and profitability gets recognized in Q3, which is the October to December quarter, since Union Assurance is a December year-end company. So we've seen strong performance in UA, and some of our initiatives that we've taken actually now translate to good profit growth. With NTB, again, the underlying numbers are very strong. We've seen NIMs actually pick up with the interest rates going up. NPLs have, from a high last year, have now come off to around 5%, and profitability, the core profitability, showed strong growth. But there's been an impairment provision of around 900 odd million on the portfolio of government securities denominated in foreign currency. NTB's exposure here is still very small or low relative to a lot of its peers. We only have around 3.5% of the total asset book in Sri Lankan government securities in foreign currency, so the exposure is relatively low. But still, for all, because of that one-off impairment, we've seen profitability being affected, but the core profitability of the bank was very strong. Just to end this presentation, I'd like to just spend a couple of minutes on this slide where you can see we're showing you how our recurring EBITDA has evolved over the last 4 years. Of course, 18-19, needless to sort of remind you, that was prior to the effect of the pandemic, as well as before the impacts of the Easter Sunday attacks. And then in 1920, we had the Easter Sunday attacks, and then 2021, the impact of the pandemic. But you can see how the recurring EBITDA has grown from last year 15 billion to 39 billion, the year before from around 20 billion to 39 billion. So I think what we're trying to convey through this is we've spoken over the last many years about a lot of the investments we've done, the capacity building that we've done in a lot of our businesses. So in consumer foods, whether it was the ice cream plant or other capacity that we invested in retail, we've sort of doubled our outlet footprint over the last 4 odd years and done a lot in building the brand. So we're starting to see the type of scale of operations that's coming through. The new distribution center that we've actually commissioned, which is around a 4 billion rupee investment, now we'll see us centralize all our dry and fresh distribution through that, which will give us significant operational efficiencies that will come through and give us better control of that supply chain. So that will help us drive further efficiencies and enable us to cater to far more many outlets that we have today. If you look at leisure, it's been up and down naturally due to the impacts that we've spoken of, but the recurring EBITDA at 3.7 billion for 21-22 is still not at the pre-pandemic and pre-Easter levels of 5.4 billion. Now, just to remind you that 5.4 billion also is not really reflective of the true potential of the leisure business at the time, because we didn't have the full inventory available. We were reconstructing Cinnamon Bentota Beach. We had possibly 1.5 of our Maldivian properties not functional because they were also undergoing refurbishments or some form of closure. As well as we've added a 4th property in the Maldives, which got added in November 2019, just before the onset of the pandemic. So if you look at the leisure business, the portfolio, we now have the full complement of our hotels and an expanded inventory, in fact. So the potential for leisure is even much higher than the 5.4 billion we were doing before these impacts. So as we go forward, notwithstanding some of these short-term impacts, we will see this business contribute far more positively. On property, we've seen Cinnamon Life, of course, the recognition coming through. We still have another 160 units of inventory for sales and profit to be recognized over the next 12 to 24 months. So you see that continuing, as well as the Trizen project. We will continue to ramp up our sales and profit recognition. So you'll see some core level of profitability coming from the property business as well. And with the other businesses, financial services, we've seen that continue strong. We could see one-off impacts on impairments and things like that, depending on how things pan out. But the core business profitability on the bank will be still very strong, we believe, and the insurance business as well. And in the other business, it's mainly, of course, there's the holdco as well as our IT and other businesses, which will continue to see the growth momentum. So yes, the outlook for these businesses is very positive. I didn't touch on the transportation business. That again has been a very strong cash cow through these years, and we will see the benefit of the translation of the rupee value of our profits as well. So that business should continue to do well, driven by the ports business and bunkering business. So overall, whilst the current economic circumstances naturally will give rise to quite a few challenges, supply chain disruptions and so on, I think what we wanted to convey through this slide is that a lot of the investments and capacity building that we've done has really started translating to the profit growth that we've been referring to, and hopefully we will continue to see that growth, of course, notwithstanding what type of short-term impacts we could see as a result of the macroeconomic conditions. So thank you. That brings us to an end of the presentation and this component of our segment. We will open up the floor now for questions and for a Q&A session. And depending on the type of questions that we have, we will hope to close this maybe by 3:30, or if we have questions, we can maybe extend the session till around 3:45 and stop there on. So Krishan, just to open up the floor for questions, if I may just ask you, in terms of the leisure impact, we spoke of the leisure impact and the positive trend that we've seen, but given the current circumstances, what sort of impact do you foresee, particularly on domestic tourism and the recovery on banquets and F&B in Sri Lanka?
I think on the domestic business in the city, the banquets and F&B, really in the F&B segment there is some impact because of the disruption we've had in the last few weeks, but I can see a very quick recovery there as long as the situation on the ground remains like what it is now, which is quite stable. And the banquet business will continue. The weddings and so on have been booked well in advance. The domestic business for the resorts, there is an impact because of the availability issues around diesel and petrol, which causes transportation issues. Again, with availability of petroleum improving, I can see the domestic business for our resorts also getting better. So.
Thanks, Krishan. Do you see any ARR impact because of the rupee depreciation? Naturally, we will have a benefit, but do you see the industry going down the route of discounting because of the rupee equivalent of revenue being quite strong?
Yeah, I think if occupancies are low in Sri Lanka because of the current issues, then we will see discounting, and that is something we would have seen regardless of the devaluation. Of course, with the devaluation, the temptation is greater because you can get the same revenue at a lower dollar ARR. So the temptation for hotels to undercut will be greater. But I think the impact on rates will come more because arrivals have fallen and occupancies are lower.
We have a question on the timeline of the Cinnamon Life project based on current visibility, and when we when we will begin operations. Maybe I'll take that question. So as we've said, we've now completed the 2 residential towers as well as the office tower and handed those over. The rest of the construction is going quite strong. There are some disruptions, but we are doing the interior fit outs, and we are hopeful that we will commence operations of the hotel in a phased out manner, where we will start operations in the first half of next year. Given that it's an 800 room property, we don't need all 800 rooms to be open on day one, but we will open maybe with roughly half of that inventory and some of the key other F&B type operations in the first half, and then a couple of months after that we will open the rest of the resort operations. We also have a question, Krishan, on just the midterm return expectations or projections for WCT. Maybe if we can talk a little bit about that.
Yeah, so the West Terminal, we met all the conditions precedent for the agreement to be effective in January this year. The on-land construction work has started. The office building is completed. Dredging will start next month, and we expect that the first phase, which will be 800 meters out of the full length of 1,400 meters, will be operational by mid to end 2024. And then thereafter by end 2025 for the full 1,400 meters to be operational. I think in terms of our return expectations based on the volume projections, which have been validated by an internationally acclaimed research organization, we believe that we can comfortably exceed our return hurdles. So we are confident that it will be an attractive project in terms of returns.
Thank you. There's also a question on, apart from the $100 million repayment of the bridging finance, are there any significant US dollar debt repayments coming up in FY 23 and 24? So if I just take that question, the two main sources of our dollar debt is the IFC loan of $175 million raised at the John Keells Holdings, the parent company level, and the $225 million we have at Cinnamon Life, that's waterfront properties. With the IFC loan that was obtained in June 2020, as we've said before, we have a 4 years grace on capital repayment, so we start repaying that loan in December 2024. So we've got another 2+ years before we start repaying capital there. And with the Cinnamon Life loan, which we obtained in or refinanced in December 2021, we have 2 years grace on capital repayments. And even once we start capital repayments, it's a 5-year loan. So the remainder of the loan will be paid over the next 3 years, but again heavily back-ended, where 75% of the repayment actually happens in the 5th year. That's the main sort of debt. We have some dollar debt in the Maldives, but that's sort of more on an ongoing basis and gets serviced out of their cash flows. We also have a question on how do we reconcile the 18 billion exchange gain reported in the annual report versus the 12.8 billion that we spoke of in today's presentation. Just to clarify, the 18 billion that's there in the annual report is the gross level at the holdco level. If you look at it in terms of the John Keells Holdings PLC, the company report that's shown there. We also had some offsetting exchange losses. So if you look at it there, the 12.8 is what is netted at a group level, whereas the 18 billion is at a company level. We have a question, Krishan, if I may put this to you, about the construction cost escalations that could impact WCT and other projects like Trizen and Waterfront. Of course, at Cinnamon Life, most of the project is completed, so that's not too relevant. But on WCT and Trizen.
Starting with Trizen, there as well, the shell is completed and it's the fit out that needs to be done. We have a turnkey contract where the predominant value is in rupees. So the contract with the contractor is almost entirely actually in rupees, and it is a large foreign contractor. There could be some cost increases that could be passed on to us, and there is some marginal impact from the devaluation of the rupee. But overall, given that we have now sold more than 70% of the units, which exceeds our expectations for this stage of the construction, we are confident that we can recover any cost escalations by increasing prices. The WCT construction cost, there is still to be finalized because we are looking at the different components. There will be some escalation. It will be above what was originally budgeted. But at the same time, we are seeing tariffs having gone up as well, along with the global phenomena of prices increasing. So again, we don't expect any cost escalation there to impact our return expectations on the project, because we think that it can be passed on in terms of higher pricing.
Thanks, Krishan. We also have a question for you on how you see your current portfolio of businesses. Are there any new verticals you would like to get into, or any businesses you want to exit? are there opportunities to expand overseas in any of our businesses?
Yeah. On the, we already have 6 verticals, so we are not looking to getting to anything new, but if there is an attractive opportunity, it's not a closed door, but what we would prefer to do is to continue to build on the verticals that we have. We've gone through a big capex cycle as it is in the last few years, and the next couple of years is about generating the returns from those investments and augmenting those verticals with further investments. In terms of overseas expansion, there could be, we are looking at 1 or 2 opportunities in frontier markets. We are not going to get into the developed markets, but again, I can't see overseas investments being material in the next few years. We are likely to be, apart from the Maldives where we have 4 properties, we are likely to be a more Sri Lanka-centric business.
There's a question whether the retail segment has already seen a slowdown in footfall and basket sizes. I think I already sort of covered this during the presentation, but just to be clear, we have not seen that. If you look at the Q4 momentum or even current momentum we're seeing on the ground, at this moment of time we're seeing footfall being very strong due to that conversion factor I spoke of, and because it's driven by the fact that modern trade has been able to stock up relatively better than I think general trade, ensure some of the essential commodities are also in supply, and because of that availability issue. The other factor I spoke of earlier about our direct imports, private label, giving customers choice, which is one of our core sort of values that we are also trying to keep to in terms of helping our customers at a time of need in terms of offering value and choice. So we believe that also is helping translate to better footfall for the business. And in terms of basket sizes, basket size of course is driven by 2 different components in terms of how many units a person buys and the price of a unit. So naturally with inflation we are seeing the price of units or that benefit coming through to ABV. We'll have to see whether there's any impact in terms of number of units. Naturally tendency would be that there can be some impact, but we are not seeing that at this moment of time. So if you look at our Q4 numbers as we showed earlier, we still saw ABV showing a positive growth, but our overall same-store sales was driven mainly by footfall growth. We also have a question, Krishan, on our move on existing city hotels, or when Cinnamon Life, the hotel is opened, any plans for Cinnamon Grand?
No specific plans. There's been a lot of speculation in the market that we are planning to divest, but there are no specific plans at this stage. As with all our assets, it will really be based on returns and growth potential. If we believe that we can get a better return on capital overall for the group by divesting some of these asset intensive investments and enhance the group return on capital, it's not a closed door. We are open to it, but right now there is no specific plans. We believe that, as we saw in some of those slides, that Colombo has tremendous potential as a destination for regional travel, India in particular. So really there is no reason at the moment for us to look at divesting these properties.
There was a question on providing insight on the foreign cash holdings at a group level and also the breakdown of foreign debt. I think I already spoke of the 2 main components of foreign debt, and we do have some debt in the Maldives as well, but apart from that it's actually the debt at the holdco with the IFC loan and Cinnamon Life. In terms of the foreign currency cash holdings, it's mainly, again, of course, each of the businesses, and in the Maldives we have cash generation. But apart from that, the cash holdings are all at the holdco level, where, as I said before, these funds are there largely to take care of our future obligations as well. We also have a question on the development of the second phase of the private placement with ADB and whether there are any revisions. So the terms of that agreement, there's no need for a revision because it is essentially an option, and that option is it gives a floor price and a cap price, and it's a rupee price based on where the JKH share would be trading, and that option is can be exercised till mid-January 2023 from, I believe, from October. So there's a window of exercise that's available, and we've disclosed this anyway. The details are also contained in the annual report, but essentially within that exercise window they can opt to exercise it subject to that floor price or cap price. We have a question on any update on the gaming license or operator coming into Cinnamon Life.
Yeah, the update, and as we've always said, we are not looking for a gaming license. We are looking to rent the space out at Cinnamon Life. We have been asking that a formal regulatory environment is brought in with formal licensing, and so that we can lease the space out to a licensed operator. The government was working on the regulations, and in fact a lot of progress was made with all the approvals from the different authorities in the government having been obtained. So the regulations have to be gazetted now. With the change in the Prime Minister and the Cabinet, we will engage with the new Prime Minister and Cabinet to see if this can be taken forward.
We have a question on the portion of total debt outstanding, with what portion is subjected to floating rates and what portion is hedged through swap arrangements. So if you look at our foreign currency portfolio, it's long term, and around half of that is actually hedged fixed rates. If you look at our rupee borrowing portfolio, over the last maybe 12 to 18 months, we converted a lot of our rupee debt to long term debt, to term debt, and in doing so we also fixed a lot of those facilities. So a lot of that term debt is actually on a fixed rate basis or with a capped rate, but of course any new borrowings that we have today or any working capital lines wouldn't have a fixed rate. But if you look at the term debt that we have, we did convert a lot. So I think over 80% or 90% of our rupee facilities at the time are all on a fixed rate or capped rate basis. There's a question, Krishan, on whether we've started importing and selling fuel at industrial level given the approvals recently, and whether this can be a permanent line going forward.
Yes, it's we have started at Lanka Marine Services. So the approval initially was for export businesses. It was then extended to tourism businesses and the telecom sector, but it has just been extended to any industry which can pay us. We need to receive foreign currency. It is has the potential to be material. Of course, the long-term sustainability of it would depend on the general availability of fuel. The approvals that we have, or the bunkering sector in the country has, is only for a certain number of months at the moment. So when the availability in the country improves, those approvals may not be extended, but it has the potential to be material.
There's a question on how big the private label is now and how you see that growing. We've targeted around a 10% private label participation. We've seen this steadily growing. It hasn't still reached there, but we've seen it growing for around 5% to possibly around 7 to 8% now. As we've sort of expanded the portfolio, we see this continuing to grow. And as I said before, we are quite mindful that we ensure that it's not just about margin upliftment, but picking the right categories for ensuring we give our customers the choice, whilst ensuring the core other branded products that are available are also part of the choice that they continue to have. There's a question on how the company procures raw materials amidst the shortage. So I think here there's been a lot of focus on working with our suppliers on the different type of terms that we can have. We've bought some of our stocks ahead of time, worked with some of the local importers as well, and tried to keep our supply chains going. The challenge is not only our own supplies, where we've secured some of that at least for the next month or two, but some of the smaller scale suppliers who would provide inputs for our businesses, where we are seeing increasing challenges there as well. So it is going to be quite challenging given the current environment. So we are looking at how best we optimize our resources and ensure we manage our production, and also what type of products we produce, so that we ensure we continue to feed the market as best as we can. I think there was a similar question on how we will secure the forex, so I will skip that. I think we did sort of touch on this, but Krishan, any insight on when the company will see the leisure sector reaching pre-pandemic levels and beyond?
Yeah, difficult to predict. I think the Maldives already is almost at pre-pandemic levels. We are expecting that over the next few months, despite China being closed, that our occupancies and ARRs could be better than pre-pandemic. And then when China is eventually opened up, which could be later this year, then we could have an unprecedented situation given the pent-up demand globally for travel. In Sri Lanka, things were picking up nicely, as I said. I can't put a timeline, but I am confident that given the improved situation we are seeing, that in a few months we will see the recovery coming back, and that by this winter, by November, December, we could see tourist numbers at pre-pandemic levels.
Thanks, Krishan. There's a question on would we consider the retail business to be relatively defensive in the current economic climate, and whether we are able to give an earnings guidance. As you all know, we don't give guidance on earnings, but I'll try to answer the first question, which is about retail being defensive. And as we sort of touched on earlier, at this moment of time, certainly that seems to be the case, and that's our expectation. A retailer generally, when you have a high inflationary environments, you see that benefit coming through. Of course, what type of margin impact it could have, what type of impact it has on your cost structures, that's something we are quite mindful of, and trying to ensure that we continue to look at efficiency and productivity. But at this moment, given the top line growth, the footfall conversion that we are also seeing, the business has been doing quite well, and we expect that momentum to continue at least over the next couple of quarters. There's also a question on the contribution from private label. I think we've already addressed that. The margin impact that we're seeing from the new distribution center, it's still a little early to really look at what type of margins benefit we would have in terms of what actual impacts have translated to our operations right now. But we expect that to grow as we go on, because there are efficiency improvements. So for instance, just centralizing all our distribution to one location, we get the benefits of scale. We ensure that we are able to use the inventory that we have in the most optimal manner. So rather than one supplier having to go to 130 outlets, where they may not deliver it exactly the way we want, in the quantity that we want, whereas now we can centralize it and ensure that we allocate stocks to the outlets that need it the most. So there are direct and indirect benefits that really help us. Even in terms of store level operations, you see the benefits where earlier if you have maybe 20-30 different suppliers coming in for a day, the store operations, the staff have to actually receive, count, do all that, take it to the back store, then refill the shelves. So there's a lot of effort. Whereas now, by consolidating your deliveries, you essentially get 1 or 2 deliveries coming from the central warehouse, and then that is brought in. We are able to control the timing of those deliveries far better. So the store operations are that much more efficient and focused on actually servicing or serving our customers. So there are those benefits, and over the next year or two, we really expect those benefits to come through. Though in the short term, of course, we see the costs of a large distribution center, 4 billion rupee investment coming in, and till we ramp it up and ensure that all our items get centralized, there will be some cost impact coming through, but net we expect there to be certainly a margin benefit coming through. I think in terms of the questions that we have for today, don't have any more questions. I think we are done. So that just leaves me to thank you all sincerely for joining this call and for your active participation, to all our local and foreign analysts. And thank you, Krishan. Thank you very much, and have a good day, a good evening to you all. Thank you.
Thank you. Thank you, everyone.